I'll be explaining to you 20 financial terms quickly. There was a time in my life that I actually struggled to understand many financial concepts and many financial terms. They were thrown around all over the place and people were using them. And even till date, there are many of us who still cannot comprehend or understand some financial terms, even the most basic ones. Or maybe you're just starting out in the world of finance and you're trying to understand some words, some terms, how they are used, what they actually mean. What do they truly mean in a layman's term? If you can understand some things in a layman's term, then you already understand it. Number one is budgeting. What is a budget? A budget is a roadmap to how you will spend your money. What do I allocate for certain things? How do I allocate my income so that it can be wisely spent? That's what a budget is. You make, for instance, $2,000 a month. You allocate $800 for rent. You allocate $200 in your feeding. You allocate another $200 maybe in your utilities. You allocate $200 for your for entertainment and grocery and all that for a month. This is what a budget is. You know how much is allocated for each thing. The second one is interest. Interest is an additional cost that you pay when you borrow or when you earn from your savings. You borrowed $20,000 for a car loan on a car finance. When that term is over at the end of maybe 4 years, that's what you're paying it for. You may be paying $23,000. Your total interest rate is $3,000. On the other hand, if you invested or saved money, $1,000 for a certain period of time, you locked it away, and at 5%, for instance, at the end of that term, you will be earning $1,050. So interest is the additional money on top of what you already invested or saved, or on top of what you already borrowed. If you borrowed money, you are paying more. It's the cost of borrowing. You are paying more for what you borrowed, or if you saved, they are paying you for what you're saving. The third one is investment. What is an investment? Investment means putting your money into an asset or a venture that has the capacity or the ability to earn you more and grow in value. If you put money anywhere or buy anything, that's not always an investment. Not everything is a good investment. Investment has to do with growth. When you put money away for something to grow, that's an investment. You're putting money in a house, that's an investment. You're buying a car for the sake of maybe transportation or carrying people, or you're using it for business, that's an investment. Investment has the chance for growth. Okay, when you put money in something for it to grow, a venture or anything else, or buying shares of a company, that's an investment. So anything that you put your money into with the hopes, and not just hopes, proven hopes that this will grow, is an investment. Credit score is the number that determines your credit worthiness. It determines how much lenders can give you. That number there, it represents that you are worthy to be given money. You can handle money. That's basically what it is. So your credit score will tell the lenders that this individual has the ability to manage money, and that they're already managing their money properly right now. If you have a credit score of 500, that's an indication you're not managing your money properly. Even lower, 600, that's an indication. Higher 600s, maybe you're getting there. 700s, 800, that means you are credit worthy. So the higher the score, the more worthy you are. The next one I'm going to define is compound interest. So compound interest simply means interest that you earn on the interest that you already earned. I know that's a little bit confusing for a lot of people. Interest already is cost of borrowing. What does it cost me to borrow this? How much am I paying that I'm borrowing this? But compound interest means that there is also an interest on top of the interest that you are borrowing. The next term would be inflation. Inflation refers to the increase of goods and services, which reduces the purchasing power of your money. Things are getting more difficult to afford. That means that your money can only purchase fewer items than it could few months ago or few weeks ago. That's what inflation means. If last year food cost $8, this year now it costs $11. That's inflation. That has literally reduced the purchasing power of your money. The seventh one will be assets and liabilities. Assets refer to the things that you own that have value, that grow in value. Say like your house, or even sometimes a car, maybe like a vintage car. That refers to an asset. An asset specifically has to be something you own. So liabilities refer to debt or financial obligations that you owe. So let's take, for instance, you have an asset of something that is worth $200,000, and then you also have a liability of something that is worth maybe $50,000. So your assets minus your liability would now produce your net worth, which is the next thing we are defining. Your net worth. Your net worth is your liability subtracted from your asset. That will determine your net worth. The next one will be 401k or ESOP, or there are different terms that people use depending on where they are. This refers to the ability for you to save money faster, to get to retirement faster and be more comfortable. That's essentially what a 401k is. So how is it different from any savings account? It's designed by your employer, whereby they are matching a certain amount that you're contributing. Some could match 100%. You may be contributing 5% of your income. They are matching 5%. That's what a 401k is. Or even ESOP, employee shared ownership plan. Depending on where you are, these are the terms they use for it. This is what a 401k is aimed at achieving. Is different from any other savings account there because it's designed by your employer to contribute more money for you towards retirement. The next one will be mutual funds. What are mutual funds? Mutual fund is a diversified portfolio that aims at bringing different people's money to invest in something. So you are investing, but you are investing with other people in a diversified portfolio of stocks, bonds, ETFs, whatever it is that you are more interested in. This helps to spread your risk. This helps to reduce the chances of you losing money because you are investing with a lot more people and in different portfolio at the same time. So many people investing in different things at the same time, which reduces risk of anyone losing their money. The next one is debt. Debt is money that you owe somebody. Simple. It's just money that you owe someone else. It could be a company, it could be a business, it could be anything, but you owe this person money. So if you have $10,000 and say you are owing $10,000, we're going to subtract the $10,000 from that $10,000 that you have, and that brings you to zero. That also almost determines your net worth as well. Debt is the money that you owe. The next one will be APR, annual percentage rate, is the total cost of borrowing, including the fees and interest rate expressed in a yearly percentage. That's literally what an APR is. So let's say you borrowed $1,000 at 10%, let's say, for a year. So that means that every year the cost of you borrowing $1,000 is $100 because it's at 10%. That means you are paying $100 for every year that you borrow that $1,000. Insurance is the protection plan that you pay to cover unexpected expenses or events, say like on a house or a car. And insurance basically protects you from any loss, because when a loss occurs, then the insurance company pays you. I still find insurance to be very controversial in many ways, and that's not something we will be talking about just yet, but I'm just giving you the definition of insurance. So insurance is you protecting your valuables, making sure that they are covered in case of theft, in case of accidents, in case of a fire, anything that happens. This will protect your property. This will cause the insurance company to pay you the value of what you lost. I believe we're in number 15 now. I can't remember, but the next one would be net income. Net income is the money that you keep after taxes and other deductions are taken from you. If you make $75,000 a year, depending on how much you're taxed, you could be going home with, let's say, $60,000 or $55,000, depending on where you live. Some places are exorbitant with taxes and it's incredibly ridiculous, like Canada, like Ontario specifically. So if you make about $70,000 a year, you could be paying taxes of up to $15,000 or just a little bit more. The next one will be equity. Equity is the value you own in an asset after liabilities and debt deductions have been taken. For instance, your house is worth $200,000, but you still owe $150,000. Your equity is $50,000. I own a property that is worth $200,000. That's the worth of my property in the market out there that determines that this is how much they say my property is worth. But then I owe $150,000 on that. That's literally what I'm owing to the bank. $50,000 is my equity. That's the next one. Emergency fund is cash that you keep away for unexpected expenses or things, events of life. How is that different from an insurance? Insurance is a protection plan and they sound alike, but insurance is external. Emergency fund is internal. Insurance is with a different company, is with a different entity that's not you. You are signing up with them to protect your goods or your service. Emergency fund is you saving your own money for unexpected expenses. You may necessarily not have insured. Insurance companies can now handle, some of them go into handling a lot of things, say like medicals and all that, but still you need to have your own emergency fund because there are other things handling life, going about. Maybe you suddenly need to travel somewhere and all that. This is an emergency. You need to access the emergency fund or you need that money right now. But for the insurance, the process of getting paid and all that takes a long time, and if you already have some emergency fund, you can cover yourself in some ways. The next one we'll be talking about is diversification. According to the name, it's pretty simple. It means spreading your money across different sort of investments or products to reduce the risk of loss, to minimize the risk of loss. You are putting your money in stocks, you're putting your money in real estate, you're investing your money in a startup, you are investing your money in different things, you are putting some savings as well. This is called diversification, which I encourage everyone to embrace the idea of putting your money at different places to reduce loss. Guys, I lost count of how many that I already told you. I don't know if it was up to 20, but we'll leave it at that. We could make another video where we still explain a little bit more of these terms. My name is Ike. If you're new to the channel, welcome. In this channel, we talk about self-improvement, finance, and just that education in terms of managing your money properly and getting better and growing financially. Our next videos, we'll be talking about how you can retire early, and we'll also talk about how you can start investing early so that you can retire early. Stay tuned for it. Thank you.